I didn't do that. I didn't create that. I didn't invent that. I didn't invent that. I can't take credit for it. I didn't invent the company or the portfolio that made that. That's a simple index tracker. That's actually an exchange traded fund. Okay. What I want to do, and I can't guarantee it, is I want to start off with, okay, at the end of 3 years or at the end of 5 years, how much is a million? Oh, sorry, at the end of 3 years, how much is a million likely to be, and what are the probabilities? Now, it might only go up to 1.5. It might go up to 2 to 2.5. Might happen sooner if there's tailwinds, and it might happen might go more if there's tailwinds, and I might get less if there's headwinds and take longer. Those bits are out of my hands. I want to know my drawdowns just so I know how bumpy the road's going to be. And the maximum drawdown in the pension might be 15%, but if I'm expecting it and know it could happen, I'm less likely to panic. Well, I'm not going to panic anyway, and I also know there is a slim possibility it could be deeper, but I know if I've got quality companies, it should be fine. I also know if I run the numbers on the portfolio, then I want to know what's the probability that 50% of the time I'm going to get more than double the money and below. So this kind of data, this is just for illustrative purposes, okay? And I want to break it down year by year. For each stock, I want to know, okay, what are the returns? Now, I don't know in a given year whether one stock's going to do that, isn't that bloody amazing, or the same bloody company 2 years earlier did that, okay? I wish every year, every stock went up. Doesn't happen. Some of them go down month after month after month. I want to talk broader problems. This is how most people pick stocks, as you know if you watch me. The reason I say you want 20 to 40 is because after 40 you've got too many, and the problem is your IFA will sell you funds, and those funds will have about 100 stocks in them, which is a complete waste of time other than for the fund manager and the broker that he uses to buy those funds through. Buy those stocks through. Utterly useless. Statistically, mathematically, academically, all proven, utterly useless for fund managers to have more than 40 stocks, okay? Which is why Warren Buffett has so few. Most of his money is in his top 5 holdings. 50% of his capital is in the first 5 holdings, okay? So, and less than 20, you've got a bit too much risk. And you can't remove market risk unless you're out of the market, i.e. 2022, right? So there's another problem. Now, I'm going to start answering some questions in a second. Okay, sorry, I've gone on and on quite a bit. This is the other problem. Don't know when to let go. So either it's going to be you're going to hold for 3 years, not forever, because Warren Buffett says that, but he doesn't actually ever hold anything forever. Okay. Well, I guess Coca-Cola. And this is the other thing. Don't look at that. Don't be drinking that when you're investing. Don't be reading that. Don't be reading the magazines, and don't be trying to find it on the internet. It's got to be calm, cool, collected, longer period. And the ways we do it through the data. But I love this. I love this from Goldman Sachs. It has been the holy grail for me. It has been a secret cheat. Of course it is. Some bloody their quantum database, Goldman Research. So I had a lunch with them, God, 20 odd years ago, and it changed my life because they presented me with, amongst other things, well, not just me, about 20 of us in a room, 30% CAGR for companies in the top quartile. Okay. In other words, cash cows, companies which produce the most cash on the capital. Now, if you think about it, it's like literally buying a cow which produces cash. That's what a cash cow is. Okay. And they do a lot better than companies at the bottom. And this is all their research team ever does. They think of new ways in which to make money. And I didn't know this. This is what they all spend their time doing. And of course, it makes sense. Yeah, by the way, if you've got 50 million, they'll take you on as a client. All right. Now, I think there's 2 simple options for private investors, their pensions and retirement and all the rest of it. Option 1, pick your own from an approved list, which is what I do. Okay. Valuation, growth, cash flow, low volatility, high consistent returns. Okay. That's like the ingredients in a cookery game with the recipe. Option 2, have somebody make the cake for you, which is the other option, model portfolios. And we're doing these more for clients now. High returns, historic, does not guaranteed in the future. Higher drawdowns to lower drawdowns and so on. And number 3 is mix and match. So let's have a look at some of what I'm talking about. Either you're going to do it through this, but please, 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 for God's sake, go through, have a big pool of CVs. Every single fund that exists there, with the exception of Warren Buffett's, picks from a narrow gene pool. They will either be UK companies or tech companies or AI companies or Dutch companies or Chinese companies or whatever. They've got one hand tied behind their backs. Okay. My job is to try and find these. I didn't even buy this one. Ravi did. And we gave him little medals. We give medals to students. We've got to start doing this again, who get over 100% in 12 months.